we'll get going. All right, like I mentioned, this is going to be recorded. One thing that I always emphasize going into these webinars is, especially if you're not familiar with some of these strategies and these different options contracts or option strategies, is to watch this again right afterwards as soon as you get it sent to you in the email. It should happen, within an hour or so. But watch it again, because after you watch something or listen to something, same as if you read or go to class for that matter, if you go over your notes and re-watch this again, it'll really make it sink in for you guys. And rather than waiting a couple of weeks and be like, you know what, I think there was something in that video I want to kind of refresh my memory on, you've really lost a lot of that information. And this is a great way to retain the information. Plus, some of the stuff might go right by you in the first time, but then you go through it again and you'll catch some of the nuances maybe. So I emphasize watching these over again as soon as you get it sent to you in the email. Anyway, this is a great strategy for trading put options. And if you watch any of my webinars or the daily market commentaries when I'm talking, I don't like to lay out a lot of money to buy options unless there is really low implied volatility percentile. And I'll go over that as we go through this webinar. But right now we're in a pretty high volatility environment, even though it's really come off in the last couple of days as we've started rallying back up in the S&Ps into the 2000s. But in that kind of scenario, when the market's rallying, volatility really starts going down. So you need to put some other strategies in there rather than just selling premium. And this is a good time in a couple of different indices that you can capture some of that low volatility. And I'll go through my thought process on that later also. But this strategy is for a low implied volatility percentile. And we will be buying this, but we are going to be financing it with another option. So that's the only way I really like buying options, is if I can somehow finance it a little bit and lower my net outlay. So my name is Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, and the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. I've been trading my own money for well over 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you learn to take control of your finances, manage your portfolio, and most importantly, manage your own risk. At the end of the day, I always tell people, if you have a financial advisor or you're putting your money in a mutual fund, even if it's a no-load fund, you would be seriously surprised at how much you are paying those individuals for something that if you just spent 15 minutes to an hour a day learning to take control of it yourself, that's money that you're really paying yourself, and it's increasing your overall yield once you've started implementing some of these different strategies. And with these strategies, it's generally geared around a core portfolio. And what's a core portfolio? Well, a lot of people already have long stocks, and a lot of people already have different types of commodities and stuff like that in their portfolio. And these are just different things that you can trade around it. This one in particular on this put option strategy is really going to be beneficial for someone that is, long a core portfolio of just say several different stocks. So, and like I said, I've traded in most markets throughout my career from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products, and in all market conditions. As you can tell down here, there were several different types of big swings I've seen. I got to go over a little bit of disclaimer, a little bit of housekeeping here. This is just saying that all of this is for your informational purposes only. We are not here to solicit any strategy or underlying for that matter. At the end of the day, we're here to teach you different types of strategies that you can implement them into your portfolios, but do that in your own way. I'm not here to tell you that something is a great buy or sell or something that needs to go into your portfolio. I'm really going to talk about things that I'm looking at for my portfolio, and if it fits your book, then implement it into your portfolios in your own way. And at the end of the day, please remember, past performance of any trading system or methodology is not indicative of future results. All right, like I said, this is going to be financing a long put. And, you know, at the end of the day, don't be a one-trick pony. Don't just take this one strategy and implement that into your portfolio. I always talk about it. It's like, you know, a Vegas casino kind of thing, where you're the house and you need a lot of different types of things going on at one time, because something might not be working out and something will be working out. For instance, you know, maybe the blackjack table is not working out, but the craps table or the roulette table is, or both of the roulette and the craps tables are working out and it's making up for the losses on your blackjack table, for instance. So think of about that way, where you have a lot of different arrows in your quiver, or a lot of different strategies going on, because they're not all going to work all of the time. So if you have a nice diversified portfolio of different strategies, it acts like a nice diversified portfolio of stocks for the most part, but you can play it on the downside. And this long put calendar is like, you know, another name for it is basically a bear calendar spread or a time spread. And the reason why it's called a time spread is because we're going to be taking advantage of the theta decay or the time decay in the front month, and in the meantime, you know, give us the opportunity to participate on a major move in the underlying later on in time. And we're going to be having to ask ourselves a few questions here, and it's like, how bearish are we on this underlying, and what is the market volatility, and is that market liquid? Now, these are very important questions to ask yourself, because market volatility needs to be really low for a strategy like this. And I'll go over and show you on the platform, you know, how if implied volatility percentile goes down, how that really negatively affects your overall strategy. We want the volatility to expand. So if we start at a very low volatility percentile and that volatility expands, that helps us out. It's going to hurt us a little bit in the front month that we're short, but volatility affects further duration a lot more than it affects the near term. Just like the theta or the time decay affects the front month a lot more than it affects the back or the further duration options. And if the market isn't liquid, you know, when the markets really start moving around and those bid asks will get really wide, if you need to get out, you're going to have to give up a lot of your profits to get out of a strategy, or give yourself a lot worse losses if you have to get out. So make sure that it's something that's very tight. I always say 10 cents wide is really what I'm looking for, and you can find those out there. If you're going to be talking about something like that nobody's ever heard of, there's either one, no options traded on that, or two, if you're looking at a quarter cent, when it gets really busy in there and the market's really moving back and forth, there is going to be about a 50 to 75 cent wide market in there. So that could eat up your entire profit. Like I said, this is a bear calendar spread, and what we're going to be doing is we're going to be selling a near-term out-of-the-money put, and then we're going to be buying a long-term out-of-the-money put. Now, I'm not talking about leaps. I'm going to be talking about something along the lines of just, say December is where we're going to be buying our long-term put. I'm not looking at a leap for this situation. Julie's asking, what volume are you looking for? I'll go through it. And, I'm not even necessarily looking at the volume. I'm looking more along the lines of open interest and the bid ask on those when I'm talking about liquidity. And I'll show you that when I go on to the options grid. All right. So we're going to be with this one, because this is really what I want to get through is a horizontal put calendar spread. Yes, there is a diagonal. It's going to have a little bit of a different risk parameter or analysis on it, but we're going to stick with the horizontal for this particular one. So we're going to be picking the same strike in the near term and the same strike in the long term. And we will be paying a debit for this particular strategy. If you're doing a diagonal, sometimes you can get it for even money or a credit in some regards, but I'm looking for more of a neutral to bearish type of strategy here. That is a little more risk in the other one than this, and of course there's a little bit more reward if you are correct in the diagonal, but we're going to stick with looking at horizontals today. And like I've talked about, the strike selection is going to be the same strike for both months. And what's our profit target? Our profit target, we need to go into this knowing what our profit is, knowing what our target is for any strategy you get into. For the ones where I'm doing for a credit, I usually look to take 50% of my profit. This is just the inverse because I'm doing it for a debit. I'm risking, say, $1 to make $2. So look at it that way. If you can make the $2, then get out. If you can get to $1.50, say in 2 or 3 days, when you've risked only $1, I would seriously consider closing out that strategy as well. If you don't have to go 20 days with this to get that other 50% or 50 cents, then I would be definitely looking to close this out. So it isn't a hard line, but that's my target going into it. If I can achieve half of that target within 2 or 3 days or 5 days, then I'm definitely going to be considering closing out this strategy, because it's not worth the risk for another 50 cents when you've achieved half of that in 5 or so days. And your max profit is limited, and that's only limited in regards to a stock can't go below zero. So a put, we're playing to the downside when we are buying it. For some of you that are very new to options, when you are a buyer of an option, if you're a buyer of a call, it gives you the right but not the obligation to purchase that underlying at the strike that you bought. In a put, it gives the buyer the right but not the obligation to sell that stock at that strike. So whoever the counterparty is who you would put that underlying to. But the max profit is only achieved if it goes to zero, for one, and two, you've already let that near-term option expire. If these go deep in the money right away, then you're never going to achieve your profit potential, so to speak. That is because there's not going to be any extrinsic value left in those options when they go deep in the money, especially right away. And I'll show you that on the options grid when we do it. But our max profit is also going to be achieved if the stock is less than the option would have intrinsic value. So if there's no intrinsic value, then you can figure it out through that. And again, I'll go over all of that. And if the stock is higher, the long-term option would have less value than when you purchase it. So if it stays high, both of those options are going to decay. And if it stays high, then our long option would expire worthless as well. So that's what I'm saying there. If the stock stays high, you're going to only have nothing left because it's going to expire worthless. If the stock is less than after that option expires, then you will have the intrinsic value only because the time value is going to fade away on that. So we do have a directional bias with this type of strategy. And your max loss is limited to the initial debt you paid. So you can't lose any more than what you're paying for an option. And that even goes with because this is a defined risk strategy. The front month being short counteracts the back month, and whenever you pay a debit, should say, that is the most you can lose with any option, as many of you probably know. And this is going to be a play on Vega, and we're going to try and take advantage of the Vega expansion. We're hoping that the volatility starts picking up and it'll show up in those, I'll show you that on the theoretical values on the option chain as well when we get into that. And we're going to exploit theta. Like I said, we want to exploit theta. Whenever you're selling an option, the best thing that can happen is that theta really ramps up right at this 45 days. So we are in like the sweet spot of theta decay, or the where the time value comes out of that option premium. And this is a chart of the theta decay. So, we're right here around 42 days. So as you can see, coming into this 35 days, 50% of theta decay happens within these 28 days or so. So another thing is I don't generally like being involved in options anywhere in here, even though you get a lot of theta decay, because there's a lot of other factors that go into that. There's also your gamma starts increasing, and so does your deltas as the closer you get to expiration. So that can eat up and counteract this theta decay. So we're going to try and capture this decay going in right now with our short put, and then the further durations won't have this extreme downslope. It's going to be closer to up here, where you can see this slope is a lot less. Oh, sorry, I'm showing it on the other screen. Sorry. This slope right here is a lot less, so this is going to be our long duration time frame. So you can see that this slope is a lot less than coming into this area right here to here. So we start seeing 50% drop coming in here from our premiums, and up here it's going to decay a lot less. So that's what we're looking to achieve, is exploit the theta and try and capture some Vega, which is volatility expansion going forward. Does that make sense to everybody so far? I didn't move along too fast there, did I? All right, good enough. All right, so now we're going to go into the options chain, and I'll show you guys some things here. So this is the options chain, right? A lot of people have seen this, even if you haven't used Thinkorswim. This is pretty much along the same lines. But what you can do with Thinkorswim, for instance, and we're right here at the 42 days that I was talking about. So this is when you start getting into that zone where the theta really starts decaying out of these options. So if you look at this down here, I have way too many open. Right here, current IV percentile. When I'm selling options, I want this to be above 50, and when I'm buying options, I like it to be below 50, and really I want it to be below 30 for the most part. So that's really where I start buying it, is when it's below 30. But if I think it's a good shot, then I will keep it at below 50 for sure. I won't buy options when it's above 50. The risk reward is just not there. Excuse me. So we're looking at IV percentile of being 45 or something like that. So what you can do is click up here on the layout, and you can go to theoretical and the mark, which is basically the mid price for the most part, or where it traded last. And you can drop right next to it, do this drop down box, and you can adjust the volatility. So if volatility were to expand by, say, 10%, and then you hit enter, you can see that these options prices, this option price increased by $1. And what we're going to try to do is take advantage of the D's. So that would be the one that we would be long, so we would capture that, premium increase. And for the same strike of, let's do 70, so we can get the same strikes. Oh, I guess we could do the same strikes anyway. So $1.25, let's say, just for ballparking purposes, the 67.5 increased, where the 67.5 increased right here by, a little less than $1. So you're capturing, that extra quarter, little better than a quarter for the most part, right? So that would increase our premium. So we would be making money off of that increase in the volatility here. And in the meantime, we would be having the theta come out of these faster than the theta would come out of these, or the time decay. So if we go to theta, you'll be able to see that theta in this column is going to be more than in this strike. So it's by a penny. So it will eat up this faster than in the further duration. Does that make sense to everybody so far? Okay, so that's a neat little thing. So we can also go here and go back to the theoretical mark. And this is why we don't want the volatility to contract. I put a negative sign in here to show volatility adjustment of negative 10%. And as you can see, if the volatility contracts on us, it's going to hurt. The 67.5 right here, click, drops to 46, and this dropped to 46. So you can imagine we lost an extra 30 odd cents. This is, I'm just showing right in this. I probably should be going over here for the puts. You're right. I am going to be selling puts in the front month and buying puts in the back month. I'm just showing how they affect each other the same way. If you look at it here, say the 62.5 calls and the 62.5 calls here, it's the same thing, even from a theta decay and volatility expansion and contraction. Anytime volatility contracts, you can see the premiums get sucked out. Why isn't this updating for me? Why isn't the put sides don't seem to be updating on the contraction for some reason? See, this was a glitch on last week's webinar when I tried to show the volatility contraction, and it wasn't letting me do the negative, and it doesn't seem like it's giving me a proper, oh yeah, this is the theoretical price, sorry. Theoretical price drops here. So you can see this is just an example as to what happens when volatility contracts. The premiums in the calls and the puts will both contract. And when it contracts on you, it hurts a lot more than in this type of strategy than when it expands. And this is a reason why I don't like to buy options also, is because if volatility does contract, it hurts rather quickly. If you hit the reset, Dan, then it goes back to 0. So unfortunately, I was looking at the mark rather than the theoretical here in that column. So -10, hit enter, and gets the date right. Oh, sorry, I didn't, you know what, this was set for last week when I was doing this webinar from before. I don't play around with that a whole lot other than for purposes of explaining this. Thank you, Dan. I didn't realize the date was wrong. So you can see the contraction in this volatility. All right. So reset, and we're good with that. So sorry, did anybody get confused with that, me talking about the calls and the theta contraction or in the vega contraction versus the puts? Because this is going to be on puts. So like I said, I look for implied volatility percentile. Yeah, it's the same principle. Thank you, Robert. So I even have a column set up here because that's one of the main things I'm going to look at for any strat. It's going to be the determining factor as to whether I'm buying or selling an option strategy. So I like to just have it up here, and I don't even care what the stock is. I mean, I'm not even going to look at the stock until I find the right volatility, percentile. So, all of these are, that one they have an earnings. So I want to stay away from earnings also in these type of situations, despite the fact that earnings have a tendency to make volatility expand for you. I just don't want to take on that binary risk in this type of directional strategy that is an unknown. So I'm going to be trying to look for something that may have just had earnings and has a low volatility. So anything that is here, I'm still probably not even looking at the stocks for the most part. I'm just scanning down here. ALV, all those have, even though these would fit the book for the low volatility, I mean, you can't get much lower than that. So that would definitely be something that would stick out in my mind for Deere looks decent. And then since we are looking at a directional bias of slightly upwards in this strategy, because we're selling a put, we do want this to continue up for a short term. So we want to catch something that is moving upwards and then just get a little overbought. This, came up against resistance, and that would have been a time to, when it was rallying, to look for a resistance area and then put that where your strikes are, and then wait for it to come off a little bit. I am being asked, is this near and long term 1 month apart? I generally, with this strategy, will look at 1 month apart. I don't generally skip further out. You end up taking on a lot more risk for not that much extra reward, and I'll try and stay with the puts. But as you can see, like the 75 puts here, you're getting $2, or you would be paying $2 for it, and then it's only 50 cents for an extra 20 odd days. So that risk reward doesn't really work for me. So I usually stick a little bit tighter. If I'm going further out in duration, it's with the leaps or something like that, and then I'm going to be trying to buy something that's very deep in the money so that you're not paying a lot of extrinsic value. And when I'm talking about extrinsic value, let me make sure, okay, those are set to 0, so this is proper. So the further in the money, so when you're out of the money here, you're paying extrinsic value. There's no intrinsic value, means it's not in the money for the most part. And one way you can tell how much extrinsic versus intrinsic value you're doing is you can look at the inverse. So for instance, this is trading at around 70, let's say 80 for just easy math for the most part. You can basically just go across here and ballpark it and see that you're only paying about 4 cents in extrinsic value. The rest of this is intrinsic value. And the further up you go, obviously, the more extrinsic value and the less intrinsic value. Here you're only having a few cents of intrinsic value in these options here. But here you can see with the dollar or the 82.50, you're paying about $1.55 in extrinsic value for this option here. Does that make sense? So for this strategy, I am only looking for something closer to the monthlies, 1 month apart. And then I will look to roll this, though, David and everybody else, to the weeklies, especially if there is a lot of liquidity. And like I mentioned before, the market is closed right now, so this is probably a slightly wider bid ask than normal for Deere. But 10 cents, 5 cents is something that I'm going to be looking for, something that's very liquid. Let's look at the Qs. Everybody likes the Qs, which is the NASDAQ. So, this is wide. If you guys trade a lot of Qs, or if usually this is 2 cents wide for the most part, so it's 3 cents wide there. And you can almost always get filled at, say, 88 cents buy or sell for the most part. There's always a counterparty willing to give up a penny to get into a trade. So keep that in mind. Whenever I'm putting an option in, I usually go to the mid price and go right in the middle because there's usually a counterparty involved there. All right, and so that was the intrinsic value. And liquidity, tight bid ask, for $100 underlying 2 cents wide is very liquid. So even when this is going crazy, it might widen out to 4 cents and you still go into the mid price, and somebody's going to be willing to give up the edge for that to get that trade. So always look for something very liquid, like something like, I don't even know why this is on here, but this stock, Horizon Pharma, you probably see a 30-cent wide for a $20 stock. This is never, I don't even know why I have it over here, but this would be something that would never, I wouldn't trade from the long or the short, just because 30 cents wide or 15 cents wide on a $20 stock, that's, the going gets rough. That's going to just get wider and probably exponentially so. All right, so let's go back to this. So looking at the Qs. Qs are something that, this for a portfolio hedge is something great, because a lot of people have a core portfolio of long stocks, so you can do the Qs, especially, determining which one of these ETFs you would use would be, what is your core portfolio? Is it very tech heavy, or, do you have a lot of S&P type things? If you're blue chips, you're going to be looking at maybe the diamonds, the DIA. So those would, you have to look at your core portfolio if you're going to use this strategy to hedge that portfolio with one click for the most part. And when I talk about in my daily market commentaries being long deltas or short deltas, if you have a core portfolio of just long stocks, you are long deltas, and you are long a lot of deltas. So deltas just means how correlated to that underlying you are for the most part. And a stock is 100 delta, because for every dollar it goes up, you make $1. Whereas with the options, your deltas are for every dollar, this strike goes up, the premium is going to go up by 50 cents, and for every dollar this goes down, the premium is going to do the same. So, and the delta here is 18 cents. So as the market goes down, this premium is going to go up by 18 cents. The gamma, the next dollar, so the second dollar it goes down, is added into this delta. So the delta would go to 21, and then it would increase by that. Not to get, that's a little bit more detailed, but that's how gamma affects delta. So the first dollar move, this premium, first dollar move down, this premium goes up by 18 cents. The second dollar, this underlying goes down, this gets added into that delta, and it would be 21, so it would go up by 21 cents, so on and so forth. The further you get closer to the money, you can see the gamma affects the delta much more. And when I mentioned that I don't like being inside of, say, this 7 days, look at this gamma expansion. So this gamma can totally bypass this theta decay. So that's why I don't like getting involved or staying in that market any further, because every dollar move or 50-cent move in this case, it's incrementally being affected. So I try and get out, 10 days before expiration, unless I want to exploit something like that for like an earnings or something like that. So other than for earnings, I'm usually staying away from anything inside of 15 or 10 days for sure, just because of that reason. Does that make sense? Hope I didn't lose everybody right there, getting a little off task for a second. So this would be a good one to do a tech heavy. I'm not super tech heavy in my portfolio right now. Another one that I was looking at, so another thing I would do is go to the charts and see what the charts look like. It looks like, I'm bearish right now, so I don't think the economy is firing on all cylinders. I've been saying the Fed's not going to go for some time, and even when they were saying they were going to go last month, I was saying they're not going to go this year because, for one thing, I don't think the Fed wants to crimp spending going into holiday season, let alone the entire economy here in the United States or globally is doing that well for, despite the fact that unemployment rate is low, there's still a lot of unemployed people there. If you really look at the numbers, it's probably closer to 10%. So you can make statistics lie. So just so you know. So I think I'm pretty bearish the overall economy or overall market right now. And I think that we've made this retracement up, this W pattern, and I think we're going to start selling off. I've gotten caught short on this rally. I didn't think it was going to be this extended. I thought we would come up and test the 2000s in the SPY. I thought we would stop a little bit short of that, the ES or the 200 level in the SPY, and come up a little short and start selling off. But it looks like, to me, the overall market could have a sell-off next week. So I'm going to try and set up something for that and have a little bit of limited risk in the meantime. If it starts, bouncing around like this, that would be the perfect scenario for this type of strategy, and then fall off. So that's what we're looking for. We want kind of a neutral stance for the next, several days, and then, or several weeks, I should say, and then slowly sell off, or once our options in the front month expire, go to the downside. So that's what I'm hoping for with this strategy. Neutral in the near term, bearish in the long term. Okay. So the Qs looks pretty good. IWM though, if we look at IWM, so we can pull this up, and where is my Qs IWM? So here's all my ETFs for the most part. And as you can see, they have really low implied volatility. And if implied volatility goes much lower, it's not going to go quickly lower. It's going to kind of slowly trickle down, which won't be too bad. But the probabilities of this increasing are greater in my eyes. So we have a nice downward sloping downtrend here. We're up against this Fibonacci level, and I haven't pulled up IWM in a long time. I don't have anything in IWM for full disclosure. I do have some positions in some of these other stocks that we could be talking about. Full disclosure, I'm not trying to get you to jump on board with me by any realm. But it was funny, I pulled this up and had these Fibonacci's, and I was like, well, what's this Fibonacci from? We're right at a 50% retracement. Looks pretty good. And I was like, oh, I anchored it right there. And then I was just like, well, why didn't I anchor it to this one? Well, interestingly enough, let's see, I'm going to just do this so I can do it quickly. I'm not going to try and nail it. But if you go from the low to the high for, the last couple of years, you can see those lines almost line up with that 50% retracement, which is pretty interesting. So that's going to act as a pretty good support. This, just so you guys know, is like 1 year out, 1 year ago, where that was anchored from. So I've had that chart on there for a while, probably since the highs there. Anyway, just thought that was interesting and would share. So that 50% lines up with the other, 23.6% one. So that should act as a pretty good resistance. I'm not a huge believer in the whole percentages and all that stuff. These lines come to fruition because so many people look at them, is the way I look at it. The overall market, these candlesticks and everything are just market psychology. It's just what the overall market thinking is, whether the bulls and the bears are taking control. It just gives me a visual on that. So, that to me looks like a pretty good line in the sand to pick for a strategy like this. Like we could bounce up against it, maybe even pop through it and trade along sideways, and then start to sell off. And then hopefully my long puts will be naked at that point, or, not covered, I should say. So IWM, so we're looking at that. So we look at the option chain, say, all right, well, For a $100 product, we got about a 5 cent range. That's pretty good. And IWM is probably usually a little bit tighter during open hours. And for this, you can go up here and pick, a calendar spread like this. And what it's going to do is just going to go to the straight across. It is as much work to me as like going in and once you pull up a trade on that and adjust it to what you want than what it's worth. So I usually just do it the old manual way. And why did that disappear on me? Where did I lose it? Oh, there we go. So you can also go down here and do the calendar spread unbalanced if you wanted, or you could go deep and wide on the calendar spread. Where's the calendar on here? Oh, because I don't have a 2 months. So you could do the calendar on a 2 month, one strike kind of thing. But I just end up going with the single and double checking myself. So if we're going to be doing a put, I usually will default, depending on how bullish or bearish you are. If you're really market neutral right now, you think that we're just going to kind of flatline for the next 25, 30 days, then you would probably look at something along the lines of a little bit tighter to the where the market or the underlying is trading. I think that we could see a little bit of pop back and forth, and so I'm going to probably go to this 30 strike or the 30 delta. And 30 delta, if you guys want to have a little bit of way to think about this, the 30 delta is equivalent to a 33%. The 33 delta is about a 33% chance of the option going into the money. So what we're kind of doing here also is playing the probabilities. If we're getting two of these at 32% probability of being in the money, there is a greater chance that it will likely happen, especially further down on the probability scale. So I would look at something like that. For instance, the 16 delta is one standard deviation move. The 32 delta is about a half a standard deviation move. And that's not really what this is. Standard deviation is the bell curve, right? So the 32 is a half standard deviation, or it's actually like the 69, so it's 31%. 31 delta is a half standard deviation. 64 is 84% probability of being out of the money, or sorry, probability of being out of the money, yes. And that is a full standard deviation move. So that's kind of what those tell you. And then like a 7 delta is, I think, 1.5 standard deviation move. So, and the probabilities are right around the same, 16% chance of it being in the money and a 32% chance of it being in the money. Now, remember, we don't want this front one to be in the money. We really want the back one to come closer to in the money at expiration, or even be in the money for that matter. But we don't want this one to really be in the money. We just want this theta to come out of here, and if there's some volatility expansion, we want that to really affect this back month a little bit more. So having said that, I'm going to be looking at this 112, 113. So I'm a little bit more bearish, especially the way the market kind of set up today. So, I would try and sell these because I want to sell the front month to finance the back month, because I don't want to lay out, $2.64. So I'm going to try and, do this where I can only have to pay $1. I also don't want to. So, depending on how big your portfolio is, you could probably do 3, if you have a $100,000 account and it's all long deltas and you're looking to hedge something like that, then you would probably go a little bit more than this to make your deltas a little bit more neutral. So $1 debit we're paying. So we're saving ourselves $1 for the most part with this strategy. And we can analyze this too, just to see what the risk profile looks like on this. And this is what a typical strategy would look like with this. And if we were closer to, we want this market to kind of slowly trickle down and come, right here. We would love it to expire right at our short strike and have it expire worthless or just below, or sorry, just above our short strike. So, if it was settled 112.1, then that would be great, because we would get all of our theta and all of our premium for that front one, and then hopefully it would continue down and we would start capturing the intrinsic value in our long option. Sorry, I was thinking about changing these. So just to show you the risk profile on the 15s, so you can tell it's a lot closer. So you have a lot less room to the downside to capture your peak on this max profit scale. So you just don't have a lot of time. And the way the market's been acting, I think you want a little bit more room to play with. So that's why I would work this, just so that with the 13s or the 12s, you got a lot more room for that movement. So that's kind of how you set it up. Do you guys have any, while I'm thinking about it, do you guys have any options that you want me to look at to kind of run through to see if it fits the parameters of this strategy? So that, if the market was open, I would definitely be putting this in. As a matter of fact, we did a very similar to this, but with the calls, we did a long call calendar, and I did it in GLD because I think GLD is going to go a little higher. So I did this strategy with a long call calendar in GLD with the 113 strike on Monday, since we did it again at the end of the day. I couldn't do it, but I was so jazzed up over the weekend, I couldn't wait for the market to open up. All right, so I got a bunch of people participating here. Okay, so what do you do if I'm being asked, what do you do if the short goes in the money at the close of the X date? Well, if it looks like it's going to go into the money, if I'm getting really close to that front month going into the money, I'm probably going to close that out. If it goes into the money, you are subject to an assignment risk. All right, so you are going to have to worry about that, or expiration risk if you're looking at it that way. So you do have to worry about that. But if the near-term put is going to be exercised, you could take that long position on, and keep in mind that you are still with the you would be long the underlying, but you still are long that put. So you are still hedged on that. So you're going to have to pay a few fees for that. So you do need to have money in your account for that long stock. But at the end of the day, if it was looking like it wasn't going to work out for me, I would be looking to close that, because I don't like to take assignment for the most part, just because I don't like that drag on your margin. So you do have to have that in mind. But keep in mind, you're hedged on it because you picked the same strikes. Does that make sense, David? All right, good. All right, so let's look at Win. That Win tried to take me down not too long ago. Actually, Las Vegas Sands, I got caught with some short calls, some naked calls in there not too long ago, and got beat up because I was trying to hedge a little bit of my Win put spread that was in my face. So here's Win. Win has had this pretty big rally. It could be starting to look overdone as far as I'm concerned. The reason why this came off the lows was, I don't know if you're aware of this or not, but Win came off the lows when China vowed to save, I think Macau, I think is the name of the island out there, the gambling mecca. And Win was really getting beat up because they were suffering there. They aren't diversified there. They only have one casino. So they were getting beat up more than the rest of the casinos. And then this was the announcement, boom, and it rallied back. So it could be a little bit overdone. I mean, talk is cheap. There's nothing in writing. There's nothing other than just a Chinese person saying that they were going to save that gambling mecca. And Las Vegas Sands and everybody else did the same, rallied as well. So all of those guys really took off. So I would have to go through and look at this. So 97% IV percentile. So, if this settles down, the reason why it wouldn't fit the book is because we can go up here and look at this theoretical mark, just check it out. So right now, whenever you get implied volatility percentile at 100%, these things are pumped up. So this would, to me, if I was looking at shorting something like this or was bearish this, I would look at a call spread and collect some premium for it, because the only thing that can really, it could stay at 100% implied volatility percentile, but for a long time. But the fact of the matter is if this goes down by, let's just say 20%, look what's going to happen to those premiums. You're just going to get crucified on those. All right, so that's why that is seriously important to look at the implied volatility percentile, which is right here. And there is a tab for that. I actually copied and pasted the whole thing that TOS has for that. So under the customized, to put that in there. And under the, this is the delayed account. So it doesn't come with that normally, but I had to have them set it up for me so I could do these webinars and stuff. All right, I'm also looking at Amazon, and Amazon I do have, why don't I have Amazon right there? All right. So in Amazon I have on a iron condor in there that's getting ready to expire, just for full disclosure. And again, you can see what is Amazon's percentile. Let's close some of these up. Let's get down there quickly. 94% again. So same scenario. Look what happens to these. If it goes down by 20%, you're just going to get killed on this strategy, because implied volatility affects further duration more than the front duration. So if this went from 32 to 17, so let's just say for math, we lost $15 there. Here you're losing, $18, so you're losing an extra $3. Okay? So that's why you don't want volatility to contract on you, especially when it's that high and it has that much further to go down. When you're looking at 17, it can't go down 20%. So, it can only expand. Your risk is for the expansion rather than the contraction on one of those. Okay, does that make sense for you guys? The probability of touch is higher than the probability of being in the money. Yes, as a matter of fact, the probability of any of your options being touched is 2 times the probability of it being in the money. So for instance, probability of it being in the money, when we're looking at a 16 delta, the probability of being touched is 32%. Okay, so probability of being in the money at expiration is only 16%. You can look at it, the probability, as just an option floor thing. We would look at it like, all right, well, my delta is 16, my probability of being in the money is 16%, my probability of this coming up and touching me. And you guys need to know that, because you don't want to panic. You got to remember, these are the probabilities, just like Vegas. Vegas doesn't panic when you're sitting at the blackjack table just crushing it, and you're just making hand over fist. You can't go wrong. What happens? You get the pit boss walking up to you and going, hey, you want to stay the night? You can stay in our suite. Well, they want you to stay in the suite because they know that if you are there longer, the probabilities are in their favor. So play the probabilities. That's what this is all about. This is playing the probabilities to make it in your favor. And that was a great point. And who was it? Harold said, it is. So yes, don't panic right away. on this strategy. If it goes up and touches you, that's fine. Just remember the probabilities are in your favor. So the more occurrences you have, the more likely you are to succeed. So for instance, in these strategies, when I'm talking about spreading your money around, don't trade big, because trading big doesn't really, make you any more money. You're just putting, you're going all in on the one table, rather than, spreading your money out throughout the different tables, even on different blackjack tables. One strategy is blackjack, say, and you got like 4 tables lined up and you're playing a different table with your money, rather than betting $100 here, you're betting 10, 10, 10, 10, 10, 10, 10, all right? You're putting $10 on each table and playing the probabilities of those tables. Does that make sense? In a sense, it's not a very good one, but because the probabilities are in the house's favor, but we're looking for the probabilities of being the house. Yes, Paul, this is recorded, and you can watch it probably an hour after we do this. Why not do the put calendar in indices more than in stocks? Bill, you know what, I do, but I don't just stick to that. As a matter of fact, the indices are really, this is a great one for a portfolio hedge, using the indices. Great point. And I agree with you. So that's why I've kind of stuck with looking at, when I was doing my examples with the Qs, with the SPY, because this, if you have long stocks in your portfolio, this is a great way to hedge an overall portfolio rather quickly and get a little bit of options experience. Maybe do one lot in a couple of the different indices or something like that. And commodities, this works with commodities. Just like I said, I did this with GLD and the ETF on gold. So, there. Apple right here, it is below 50% on the IV. Somebody's asking about looking at Apple. So we'll look at Apple here, and we don't want volatility to contract by 20% here, because look what happens to our prices. So let's go back to delta and the gamma. And then another thing I would always look at is the chart on Apple. Apple has been in a down pattern, and I am bearish Apple. I don't think I have any Apple in my account right now. Bearish Apple just because I have a whole soapbox. I don't think the Apple car is going to work out. The Apple Watch is kind of as far as I'm concerned, I just don't think it's taken off like they wanted it to. So I could easily see Apple coming down. Plus, they're not being innovative really, as far as I'm concerned. The watch was kind of innovative, I'll give you, and the car is too, but I just don't see them working out anytime soon and being a real drag on their margins. So I could be bearish Apple, and I would look to sell something like these, these 16, 17 area. So then I would look here to see where that would come into. Sorry, it's still on the other one. So I would want it to come down, probably test this area. So the 05s. So the 05s, yeah, that's right around that 30 delta that I like. So, that would be one that really kind of fits it. Other than, I would probably shy away from it just because it's so close to 50 on that current IV percentile. And if you guys don't know what the IV percentile is, that's what this is right here. This is on a daily type thing. And the way you come up, the way, TOS comes up with this is you take, there's a numerator and a denominator, right? So on the numerator, on the top of the equation, you take where it's trading now, which is 40, and subtract that from the low, which is, let's say, 18 or 20 just for math, 18, whatever, 18. And then you divide that by the denominator, which is the high, 62, minus the low, which is 18. And then you divide those two by each other, and that's how you come up with your IV percentile. And TOS goes back a full year. This is not quite full year on this, so it's a little bit more difficult to figure it out. And if there's a huge outlier like in this August spike, this is added into that. So sometimes, you know, I would look at it like, okay, this is really the high for the most part. You know, we did have that major spike, but this is kind of like the high historically looking. So having that in the equation, that would bring this ID percentile a lot higher, probably be closer to 70% or something like that. Being asked if I do have intermediate and advanced options online videos to offer. Yes, Wendy, we do, and somebody will throw that in there. This is, I did a lot of the more basic ones earlier on, so if you go back and watch the other webinars, you can follow those. All right. Does that make sense? So who is asking about Apple? David, did I answer your question? I'm bearish Apple, but I would probably look at a different strategy than this one, because, you know, it's a 50-50 on whether you're going to get that implied volatility expansion or contraction. So I would go with something a lot lower, like 30 or something below 30 is where I would really like, unless for instance I thought that it was going to kind of flatline for a while, but you know, it could stay in this range. I mean, that is a nice little range being built here for Apple. So it doesn't work for me, but it doesn't mean that it doesn't work. Okay, so you know, if it stayed in this range, then that would be great for you, because you'd be at the 105 strike, which is that 30 delta, you know, and you know, if it stays in there, that would be beautiful, because you would get that contraction in vol, or actually you would want the expansion in vol, I'm sorry. So you need the expansion in vol. But if it just bounced around here, the volatility would probably remain right around there, and you know, you'd get the theta contraction. And earnings, yes, you don't really want to play with the earnings. Usually I have, yeah, Apple's got the earnings, right? That's another reason to drop that out. The 27th, so yeah, that falls in your options. So 27th would be, yeah, right in the, so you would, the November would come off in the 27th, so you'd have to be very bearish in Apple to have that work out. You'd get the vol expansion in the later months, but you know, you're very directional at that point, naked, or just naked long your puts. Good point, Dan. Thank you. Does anybody else have any other questions before we start to wrap this up? I don't want to leave anybody high and dry on this. So if you are more of a newer options trader, we do have classes and stuff like that for you guys. Your long MO on Sandu. Oh, Ultra. I was thinking MON. Yeah, this would be great for a strategy for the downside. That doji right there looks pretty, I mean, it shot above. Anytime it shoots, it popped above there and came back. I mean, that's a pretty bearish signal from a candlestick type pattern. The fear I would have is that this would start to really sell off down to this 54 rather quickly, and you wouldn't want that to happen. Does that make sense? If you're long MO outright, you know, I would probably, what I would do if I were long MO is maybe sell some calls up here or something like that, depending on how long or where I was long from. Just start lowering my basis on that if you want to stay long. Just lower your basis, so if you do get a sell-off, you know, it's not going to hurt as much against your net lick, Robert. That makes sense? Do some covered calls on that. And what was Emo's applied volatility rank on this? Reynolds. If you're long Reynolds, same thing. I would probably, I'm bearish though, so I'm a little bit biased. If I was this and we're at all-time highs for this, and I would be looking to do some covered calls if I was long stock in that, because that one had really low implied volatility, but this one looks like it's in the lower, it's got to be below 50 on the implied volatility, right? Yeah, 40. So, and remember, when the market sells off, implied volatility goes up almost always. Implied volatility doesn't really go down when the market is doesn't really go down when the market's selling off. It can rally hard, and you'll see implied volatility go down. So, I would definitely look to maybe do some covered calls on that. Excuse me. What's good? Index put spread to hedge. If those were the ones I was long, I would probably look to do just covered calls on that. I don't know. I would probably think that it would be in the Russell or something like that, Scott, if you wanted to do this spread to hedge all of them at once. I would probably look at that Russell, because the Russell just looks technically, fundamentally right for this strategy. If you didn't want to just do covered calls or something like that. Robert, I would probably look to do this strategy here that we're looking at, the long put calendar for hedging that. I would be okay with that. What strike? Right there at the strike we were talking about. I mean, depending on how bearish I would be. I mean, I'm pretty bearish, so I'm a little further away. If you're not as bearish, then you could go a little bit tighter. So, the more neutral you are, market neutral, thinking the market's going to trade sideways, the closer to at the money you go with this strategy. The more bearish you are, the further out of the money you would go. So you can keep going further out of the money depending on how bearish you are. But remember, you're less likely to become in the money the further out you go. And you kind of want that back month to go into the money. Doing long put. Robert, that's going long put a few months out. That's possible, but again, I don't like to buy options unless it's kind of like being financed. Okay. Hussam, I like to stick with this 45 days to 35-day expiration and sell options, because you get a lot of theta decay happening really quick. So if you're new to options, you can check out the link at ProTrader Strategies, or email us at trader@protraderstrategies.com, and we can set you up with that. I'll go over all that stuff pretty soon. So as I think it was Wendy that mentioned earlier, she got something in the mail for a special deal, and we do have that. But keep in mind that with this premium offer, you get the daily market commentaries where I go over what I'm doing every single day, in and out of the market. Well, Fridays I usually don't have time because I'm setting up for the webinar, especially when it's usually a little bit earlier, but we've been doing it later to get it after the market, just so that everybody has a chance to do their trading during the day. But I do a market commentary where I'm talking about whether it's geopolitical, economic data that's coming out, and what I'm doing on a daily basis and why I'm doing that on a daily basis. So we're trying to teach you some different strategies that are pertinent to that particular day, what I see. So, you get that. You also get the options trading lesson video archives, which is a little bit shorter videos, are like 15 minutes, more of a refresher, so you don't have to watch maybe the whole video over again, but they're a little bit shorter. And I also go all the way back to the beginning of options and where they originated, which, just for your purposes, was Lee's from the Leadus, and the Lees from Leadus, sorry, and he basically cornered the market in olive presses. So, and he did it with options contracts, and nobody knew what an option contract was at that time, but that was the first time it was really seen, and Aristotle even wrote a story about him. So, and then these trading workshops, which are an hour long, and we love your feedback. So please, write in if you want to see a video on a particular strategy that we may have not covered, or have some questions about it. Please reach out to me. I'm more than happy to talk to you guys about that stuff, because I want to make sure you guys get this down and do it the right way. So please do that, and you can go check out. The link is in the chat box there. So if you look at the little chat box there, there's a link there. And, like I said, in future webinars, we're going to be drilling down on different options components and trades that I find and where I find them appropriate. There's the link right here. Also, like I said, it's in that chat window, protraderstrategies.com, Wolfman Special Options Trading Webinar Offer. Or you can call us at 310-598-6677 or email us at trading@protraderstrategies.com if you have any questions. Thank you, Robert. Appreciate it. 310 equals LA. I don't know what that means, Robert, because 420 something. Los Angeles. Go Cubbies. Area code 312. Yes, 310. You're right. The 310. Robert's in the 310. Little envious, although I heard it's supposed to be super hot there this weekend. Anyway, I appreciate all you guys' feedback. I hope you guys got as much out of it as I hoped. Like I said, you guys are going to get this here in about an hour at best. Please go back and rewatch it, because especially if you're newer to options, it will help it really sink in if you watch it right away. If you wait a week, it's not going to sink in the same way. Yeah, that's right, Robert. Go Cubs. Take down the Cards. So it's getting exciting. I got goosebumps. Long time season ticket holder, so I'm excited. Anyway, so check that all out. I appreciate all your guys' participation on this. It really makes it a lot more fun for me, and I hope you guys can make it for the next webinars, because I do really enjoy the back and forth with everybody, even when people are getting snarky. So appreciate it. And that's about all I got for you guys today. If you can't take that, take it easy.